dollar. Hello, I am Ross Burland. I'm an analyst and editor for FXStreet. I am a bear on the US economy. I'm a bear on the US dollar. I don't believe that the Federal Reserve are in a position to raise interest rates, nor will they be at any point this year, potentially even into next year. I think the next move, in fact, from the Fed will be an interest rate cut. My question is how far do they go before QE4? The US economy, in my opinion, is likely to be already in a recession. We are starting to see numbers that are recessionary type numbers, but the markets are not. Well, I think actually they're starting to wake up a little bit to that elephant that's been in the FOMC's room the boardroom for quite some time now. The ADP report today was slightly better than expectations, but that is in no way an absolute prelude to the Nonfarm payrolls numbers on Friday. They can be seen somewhat supportive of a stable report. We're looking for somewhere between 180,000 jobs to be created for the month of July. That is against a backdrop of a very strong report. Well, it depends how you look at that, but a very strong headline number for the month of June. I say it depends how you look at that is because you need to look behind the headline and understand how these numbers are created. In fact, I tend to look at the revisions and I would trade more on those than the actual headline itself. It depends on your trading style. A strong headline number would usually result in a very strong spike to the upside in the DXY, in the US dollar. Speaking of which, we've just come off, 96.05, I think the low was. That's in decline. Gold is rallying, and you've got to ask yourself why. As I said, it's because I believe the markets are starting to wake up to that elephant that's been in the FOMC's room. The FOMC, in fact, remind me a little bit about my exercise routine. It's all talk, no action. I don't think there ever will be action. I mean, there has to be action at some point. But like I said, I think the next move from the Fed is actually going to be a rate cut. Just look at the GDP report that came out last week. Look at the manufacturing sector. Look at the consumers. I mean, you've got the Democrats at their conventions claiming how wonderful the consumer sector is going in the US economy, which is the backbone of the US economy, because essentially the US economy has become, more of a slave to China than a manufacturing powerhouse that they used to be. The US economy has a real tough time ahead. We have huge risk. There are huge headwinds from overseas for the US economy, and it was quite amazing that the FOMC have suggested that risks have diminished. We've got a European banking sector on the brink of failure, with Deutsche Bank down about 95%, the Italian banking sector in a complete and utter chaos, if you like, and an ECB that are non-willing to bail them out. They're actually starting to wake up to the idea that is not the medicine that is needed, and much like the Fed, the Fed, in fact, they are wanting to keep that medicine going. And that's why I think QE4 is going to come. Just look around. Look at the Japanese yen. Markets, as I said, are starting to wake up to the real picture here. You've got a Bank of Japan that are determined to try and weaken the yen, but it's doing anything but. And they're failing. Same again with the RBA. I mean, why on earth did they cut interest rates? What is wrong with being slightly below their target of 2 and 3%? Why do you want inflation? Why do you want higher prices? What's wrong with having an economy that's where consumers are able to enjoy lower prices? What their objective is to weaken their currency. We have a global financial system where that depends on central banks weakening their currency. Now, looking ahead for the US economy, well, you need to start looking at the bigger picture. So if it is so consumer based, and if the consumers are doing so well, then why are we starting to see a housing market struggle? Why are we starting to see the automobile struggle? It's down about the combination between Chrysler, Ford, and General Motors. I mean, General Motors last got a bailout during the financial crisis, which I, by the way, was still in, and it's going to get a lot worse. But it's down about the combination of those three are down about 8%. Now, when you look at the ISM manufacturing data, yes, there was a slight improvement, but the poorest factor of that number was in fact the job sector. So keep it short. I mean, there's just too much to talk about. But this non-farm payrolls result, yes, potentially it could be a stable report. Buy the dollar on a good number, but don't forget to look behind that data, look at the revisions, and take a longer term view for a weaker dollar.